President Donald Trump told the New York Post that talks to end the Iran war could resume over the next 2 days, boosting investor optimism. Wall Street's main indexes rallied on Tuesday, with the Dow gaining 0.2%, the S&P 500 adding more than 1%, and the Nasdaq climbing nearly 2%.
90% of professional fund managers, people who do this full-time, with research teams, Bloomberg terminals, and decades of experience, get beaten by a strategy so simple you can set it up in 15 minutes. Not sometimes, on average, every year. That strategy has a name. And if you watched our last video on why your brain is wired to lose money, this is the solution I promised you. If this is your first time here, perfect. By the end of this video, you'll know exactly what this strategy is, why it works, and the 3 steps to start today. Even if you've never invested a single dollar before, it's called index fund investing. Let's get into it. Let's start with the basics. What actually is an index fund? Imagine a horse race with 500 horses. Most people try to pick the one winning horse. They study the horses, read the predictions, listen to the experts, and most of the time, they're wrong. Now imagine, instead of picking one horse, you could buy a tiny piece of every single horse in the race. If any horse wins, you win. If the race as a whole does well, you do well. You've stopped trying to beat the race, and you're just owning it. That's an index fund. An index is just a list. The S&P 500 is a list of the 500 largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, Google, Berkshire Hathaway, the 500 biggest players in the American economy. Those 500 companies represent roughly 80% of the entire U.S. stock market by value. When you own an S&P 500 index fund, you're not picking stocks. You're effectively owning the American economy. An index fund automatically buys a tiny slice of every company on that list. When you put money into an S&P 500 index fund, you instantly own a small piece of all 500 companies in a single purchase in seconds, with no expertise required. And here's the part that surprises most people: that bet has paid off remarkably consistently for over a century. But here's what that actually means for your money. And I want you to stay with me for the next 2 minutes, because the math in this next section is the reason I made this video. So, why does this actually work? Let's talk about the math, because it's more powerful than most people ever realize. The S&P 500 has averaged roughly 10% per year over the last century, through wars, recessions, crashes, and pandemics. Now let's see what that means for your money. Imagine 2 people. Both are 25 years old. Both invest $500 every single month for 40 years until they're 65. Same amount, same time period. The only difference is where they put it. Person A puts their $500 a month into a savings account, earning 1% annual interest, which is roughly what most standard savings accounts have paid historically. Person B puts their $500 a month into an S&P 500 index fund and earns the historical average of 10% per year. After 40 years, Person A has approximately $296,000. Person B has approximately $3.2 million. Same $500 a month, same 40 years. The difference is roughly $2.9 million from one decision about where to put the money. That is the power of compound growth. And that is why Warren Buffett, the most successful investor in history, has publicly said that most people, including his own family after he's gone, should just put their money in a low-cost S&P 500 index fund and leave it there. The most powerful investing strategy ever invented is also the most boring one. That's not a coincidence. It's the point. One important note: past performance doesn't guarantee future results, but 100 years of data through 2 world wars, the Great Depression, and a global pandemic is the strongest signal we have. But here's the thing the math alone won't tell you. Knowing all of this isn't enough. Millions of people know that index funds work. They've read about it. They've heard Buffett say it, and they still don't do it. Or they start, panic, and stop. So what actually separates the investors who build wealth from the ones who don't? It's not knowledge. I want to show you something, and it starts with someone you've already met. Now, I want to connect this back to something we talked about in the last video, because this is where index fund investing and investing psychology meet. Remember Sarah, 34 years old, invested $10,000 in January 2020, watched it drop to $7,200 during the COVID crash, sold at the bottom, and never got back in. Sarah's story isn't unusual, it's the default. It's what happens when you're making real-time decisions with real money during a real crisis. Your loss-averse, recency-biased, herd-following brain takes over, and it costs you. Now, meet Marcus. Same age as Sarah, same income, same market, same COVID crash. But Marcus did one thing differently on the day he opened his account. He set up a $300 automatic monthly contribution to an S&P 500 index fund. And then he closed the app. When March 2020 hit and the market dropped 34%, Marcus's portfolio dropped too. He saw the number. He felt the fear because he's human, and loss aversion is wired into all of us. But here's the thing, the decision about what to do had already been made. His $300 contribution went in automatically on the 1st of every month, including March 2020, right near the bottom of the crash. Marcus didn't buy the dip because he was smart. He bought the dip because the system bought it for him. By the end of 2020, his portfolio had not only recovered, it was up. And his March contribution, made at the market's lowest point, had already gained 65%. Index fund investing doesn't just give you better math. It gives you a system that works with your psychology instead of against it. It removes the decisions that your emotional brain was going to get wrong anyway. That is the real power of this strategy. All right, you understand what an index fund is. You've seen the math. You've seen how it works with your psychology rather than against it. So, how do you actually start? 3 steps. That's it. Step 1. Open a brokerage account. A brokerage account is just an account that lets you buy investments, like a bank account, but for the stock market. For long-term index fund investing, 3 brokerages are the most trusted and beginner-friendly: Fidelity, Charles Schwab, and Vanguard. All 3 have 0 account minimums, meaning you can open an account with $1 and no trading commissions. You can open any of them online in about 15 minutes. One quick note, if you're investing for retirement, consider opening a Roth IRA. Your money grows tax-free, which makes a big difference over 40 years. I'll cover this fully in an upcoming video. Step 2. Choose your index fund. For most beginners, you only need to know about 3 funds. VOO, that's the Vanguard S&P 500 ETF. FXAIX, Fidelity's S&P 500 Index Fund. And SWTSX, Schwab's Total Market Index Fund. All 3 have extremely low fees, less than 0.05% per year, which means on a $10,000 investment, you're paying about $5 annually. That's it. If you open a Fidelity account, use FXAIX. Schwab account, use SWTSX. Vanguard account, use VOO. Don't overthink it. These are all excellent choices. Step 3. Automate your contributions. This is the step that separates the investors who build wealth from the ones who don't. Set a fixed dollar amount. It can be $25, $50, $100, whatever fits your budget, to automatically invest on payday every month. You set it up once. You never have to think about it again. The money moves before you can spend it, and before your brain can talk you out of investing it. That is the entire strategy. One account, one fund, one automatic contribution. No stock picking, no market timing, no financial expertise required. This is not personalized financial advice. Please do your own research or speak with a financial advisor. But the strategy I just described is the one Warren Buffett has publicly recommended for ordinary investors, and that's a pretty solid endorsement. You now have everything you need to start. One brokerage account, one index fund, one automatic monthly contribution. That's the entire strategy that has quietly built more ordinary wealth than almost anything else in the history of investing. Your brain was wired for a world where loss meant danger and inaction meant death. But your portfolio doesn't have to pay for that wiring. One decision, one system, then let it run. Before you go, one question for the comments. comments, and I genuinely want to know the answer. What's the one thing that's been stopping you from investing until now? Was it not knowing where to start? Fear of losing money? Drop it below. I read every single comment, and the answers always help me figure out what to make next. Now, there's one more thing I need to tell you, because even investors who do everything we talked about today sometimes make a quiet mistake that costs them thousands of dollars over time. They don't even know they're doing it. That's what the next video is about. It's right here, and I'll see you there.